Welcome to the lecture on financial distress, trade-off theory, and the pecking order theory. To bring it back to kind of where we are in the course, we'll pull up Modigliani-Miller again. Okay, so Modigliani-Miller said that finance is irrelevant under the following assumptions. No taxes, no information asymmetries, etc. You've seen these before. We spent a lot of time talking about taxes. Today we're going to start with bankruptcy. In the past, we've said that if the company goes bankrupt, you just transfer the assets of the company from the equity holders to the debt holders, and the debt holders just run the show with no problems. Either there's no costs of transferring ownership, you don't lose any NPV or anything like that. Things just move seamlessly. We're going to talk about why that's not the case. When is bankruptcy going to affect the value of the company? And what is that going to do to our capital structure conclusions? Entering into this lecture, if the only assumption we violated were taxes, and we get these tax shields when we take debt, then we said, well, you want to take on as much debt as possible. But once we incorporate some of these costs of bankruptcy, we'll see that there's a countervailing effect. And in fact, you don't want as much debt as possible. You want to trade off the value of the tax shields against the value of the bankruptcy costs, right? Trade the cost of bankruptcy against the benefits of the tax shields. And that's the trade-off theory in a sentence. That's all we're going to talk about. Then we're going to move on to something called the pecking order theory. So once we talk about these costs of bankruptcy, then we're going to talk more about information asymmetries and conflicts of interest. This shows up a little bit with bankruptcy because you'll get conflicts of interest between the debt holders and the equity holders, and that can destroy firm value. Okay, so we'll use that to kind of segue into the conflicts of interest and information asymmetries. Okay, so here's the agenda for today. We'll define some terms, talk about bankruptcy and distress, then we'll just formalize something called the trade-off theory. That's just trading off tax shields against the cost of bankruptcy. And then finally, we'll talk about the pecking order theory, and this is all about information asymmetry. The management's decision about raising money is going to reveal certain information to the investors, and so investors know what's going on, and management knows that investors are going to know what's going on, and so that's going to create a pecking order. That means that you want to do certain things first. You want to raise money one way rather than other ways, depending on how this shakes out. Okay. First, we'll define some terms. So financial distress is not necessarily bankruptcy. It could just be liquidity problems where you're worried that you won't be able to pay. Okay, so there's an inability to pay or a potential inability to pay, and this can be costly. The costs of bankruptcy or distress are costs arising from either going into bankruptcy or being worried about distress, right? So it's not necessarily, I'm bankrupt, now there's costs. There's also costs kind of in anticipation of going into bankruptcy. The costs of bankruptcy or financial distress are borne by the shareholders, right? The shareholders are the residual claimants. You pay the bank first, and the shareholders get whatever's left. That means that the bank knows about these costs, right? The bank knows that there's certain costs of bankruptcy, costs of distress. And so before the bank gives you a loan, they've already priced that in, so to speak. Right? They've already figured that into their calculations. And so who's left bearing these costs? Well, it's got to be the equity holders. It's got to be those residual claimants, because the debt holders aren't going to write a contract kind of ignoring these costs. Right? The debt holders know these costs are there. That gets baked into the contract that they write with the firm. They're not going to bear the costs. It's got to go to the equity holders. Okay. So that's all spelled out here. The debt holders are smart. They foresee the costs. They foresee that if there's a default, they're going to pay it. So that means that it gets factored into the contract ex ante. Hence, the value must come from the equity holders. Okay. There's two forms of bankruptcy in the U.S. We'll talk about both of them. I'll just give some institutional details here before we get into the different types of costs. Chapter 7 bankruptcy is liquidation. Okay, you just sell whatever the firm has. You use that to pay off the debt holders and whoever else is owed money by the firm. Chapter 11 is reorganization. The idea here is that the company's worth more alive than dead, so you want to just reorganize things so that everyone is kind of better off than if you just liquidated things. Okay? No one's going to be happy, obviously, to be going through bankruptcy, but you're more happy to keep the firm alive and earn money from an operating firm than from a liquidated firm. Both can be triggered in two different ways. You file with the federal bankruptcy court. It could be that the debtor seeks protection. This would be a voluntary bankruptcy. So if you're the company and you've got a lot of debt that you can't pay, you file for bankruptcy. That would be voluntary. The debtor, that's the person who borrowed money, is seeking protection. The alternative is involuntary bankruptcy. Now the bank, they see that they haven't gotten paid, they file a petition so that the company goes into bankruptcy. This is involuntary from the perspective of the debtor because it was the bank, it was the creditors who started the process. The debtor did not start the process. Chapter 7 is relatively simple. You're just going to sell all of the assets. There's going to be a trustee that comes in and makes sure that you sell things the right way. And the trustee is also going to make sure that the proceeds from that sale, the proceeds from that liquidation, go to people in the right order. So here's the distribution. Here's the order of proceeds. The secured creditors get paid first. So the creditors, those are lenders. Secured means that in their contract, they tied the loan to certain assets. So for households, if you get a car loan or if you get a mortgage, for example, the loan is tied to the asset. If it's a car loan, the loan is tied to the car. If you can't pay off your car loan, the lender can take your car. Likewise with a house. If you buy a house, you get a loan for that. The loan is secured by the house itself, so that if you can't pay the mortgage, the bank can take the house. So they get paid first. After that comes the administrative costs, so things like the lawyer's fees, the court costs, etc. Then employees come next. So if employees have been working without getting paid for a while because the company's been in distress, they get paid after the lawyers. Then the government. Then we move down to unsecured creditors. So these are lenders who did not specify collateral in their contract. So these would be like credit cards, for example. When you get a credit card, the bank doesn't specify that they're not, the loan is not secured by anything. It's not secured by your car or anything. They just kind of get whatever's left. Then after we've paid off the lenders, then we move on to equity holders. And even there's this hierarchy. So the preferred shareholders get paid first. And then the common shareholders, those are the residual claimants that I mentioned before. It's residual, so they just get whatever's left. All right, residual is just whatever's at the kind of bottom of the barrel after you've paid everybody else. Chapter 11 is more complicated because you're going to continue to operate the firm. You're going to reorganize the claimants. Okay, so there's all of these different people who are owed money by the firm. You need to reorganize all of those contracts so that the company is able to operate and still make these other claimants happy. It's going to give protection to the debtor, to the borrower, for a period of time so that management can come up with a plan. Right? You need to have some way to reorganize the company so that it's worth more operating than just liquidated. Right? You don't want to have to liquidate in Chapter 7. You want to keep operating the firm, but that's going to require a little bit more plan. So you get a little bit of a break from the creditors while you come up with the plan. It's possible to get extra financing during this period if you need it to pay employees, for example, but obviously because it's in bankruptcy, you need to You can't, management just can't make these decisions by themselves. It has to go through the court. Generally speaking, management will have 120 days. This is oftentimes extended, but that's the starting point to submit a plan. Then what happens is the claimants vote. So a claimant would be, these are all the different types of claimants. You've got secured creditors, employees, the government. It's about the actual investors. So lots of different types of investors. Secured creditors would be one investor, unsecured creditors, preferred shareholders, common shareholders. There's all of these different types of investors in the company. They have to vote on the reorganization plan. If half of the number and 2/3 of the dollar amount of each class, including the common equity, if they accept the plan, then it's adopted. So it's a pretty high hurdle, as you can see. Half of the number and 2/3 of the dollar amount. So it's like a super majority, we would say, kind of in a political science context, you would need a lot of people to agree to a reorganization plan. If it fails to be accepted, then the judge has some discretion. They can tell management to come up with a new plan and hope that that gets accepted later on. Or they could instruct the claimants, could be the debt holders, for example, to come up with a plan of their own. Or if everything else fails, they can force what's called a cram down. The idea here is that the company is still worth more reorganized than liquidated. So as long as all of the claimants are better off reorganized than liquidated, then the judge can just say, deal with it. That's what we're going to do. Okay. But the key is, so it's a cram down. The judge is kind of cramming it down their throats. You have to take this as long as everyone is better off than if it was liquidated. That's the key condition. You can see, thinking about this, it's going to be very hard to get everybody on board with the same plan. So it can lead to high costs. It can take a long time to work through the process. Even if, say, management comes up with a great plan, management has a great reorganization plan that makes everybody better off than if you liquidated the company, there's still this conflict between, so suppose you're the unsecured creditor. The management's plan, the reorganization plan, may make you better off than if the company was liquidated. But is that the best you can do? You can always try to eke out more gains by kind of negotiating or fighting this war of attrition with the other claimants. And so that's what can get expensive. There's some very direct costs of bankruptcy. So if you go into bankruptcy, you have to pay the lawyers, you have to pay the judge, you have to pay all these court fees, and this can add up. So here's some noteworthy costs. So in Manville, when they went bankrupt because of the asbestos litigation, they had to pay $200 million in just bankruptcy fees. Okay, this isn't the result of the lawsuit, this is just in the fees themselves. Eastern Airlines in 1989, $114 million. Macy's, $100 million. Enron, everyone in Houston knows about. There's just exorbitant things that came up out of that proceedings, $175 an hour librarians, paying for bar tabs for lawyers, right? Ridiculous things like this that add up. So on average, when people look at these things systematically, it's about 2.8 to 7.5% of firm value when they file. Okay. So you go into bankruptcy, and how much are you going to pay the lawyers? It's going to be about 5% of the company value. That's for a reorganization. And then for liquidation, it's even more. Liquidation, those companies are in real dire straits. So they're not worth very much. The fees are then a greater fraction of the company value. The fees are 7.5 to 21% of the firm value for Chapter 7. The question becomes, are these large? Okay, now, you look at the numbers and, $200 million, $114 million, $100 million. These are big costs, right? Even if you're paying 20% of firm value, that sounds like a big cost. But the question is, compared to what? What are we concerned about in corporate finance? We're interested in weighing those costs against tax shields. we need to weigh the benefits of the interest tax shields against the costs of bankruptcy. If you go bankrupt, you have to pay a lot, but you only pay these direct costs if you go bankrupt. When do you get the tax shields? Well, you get the tax shields all the other times. Every time you don't go bankrupt, you're saving money in taxes. If your tax rate is 20%, then you're saving 20% of your profits in taxes because of the interest payments. So these direct costs, they're very conditional. You only pay them with some small probability that you actually go bankrupt. On the other hand, on the other side of the ledger, you're getting the tax shields all the time, and you're saving your tax rates all the time. So in short, these direct costs, while they look large and while they're very important if you go into bankruptcy, they're generally not going to be big enough to offset the tax shields. Most companies are going to do better taking on a little bit more debt, getting more tax shields. They're still not going to go bankrupt with any expectation. So they'll get the savings and not pay any cost. That means that we need to have some other type of bankruptcy cost. The direct costs are probably not going to be big enough. What could be some indirect costs? These are costs that the company bears that are not lawyer fees or not administrative fees, court fees, things like that. But they are real costs. They reduce the value of the company because of this bankruptcy problem. I think the way to think about this is if you take a job, say, at a company that has a lot of debt, what are you worried about? And so suppose you just graduated, you're entertaining two different offers, say two different airlines, say United Airlines and Southwest Airlines. Okay, so generally speaking, the work is going to be the same, but suppose United Airlines has a lot more debt than Southwest. You're worried if something comes up, United's going to go bankrupt, they're going to go into a big reorganization, and you may lose your job. Southwest is more secure financially, and so if something bad happens, you're still going to be on relatively stable footing there relative to United. What does that mean for the company? That means that United is probably going to have to pay you more to work for them. Right? It's more costly for you personally to go to United because there's a greater risk that the company is going to go bankrupt and you'll have to go somewhere else. That means they have to pay that cost. Southwest doesn't have to pay that cost, or they wouldn't have to pay as much. That's the type of indirect cost that the company has to pay. In a competitive labor market, United's going to have to pay you more to compensate you for that risk. You can think about that logic with all sorts of different relationships that the company is in. So it's with their employees, they may have to pay their employees more. But you can also think about this with suppliers, for example. Suppliers don't want to invest in a company if they're worried that it's going to go bankrupt. And then once they go bankrupt, all of those relationships get kind of jumbled up. Right? If we go through a process like this with reorganization, if you're any one of these folks, right? If you're any one of these people who the company owes money to, then you're going to be worried. If the company goes into bankruptcy, where exactly am I in this order of distribution? If there's a reorganization, how much priority are my claims going to get? Right? So, employees are here; they're below the secured creditors, but suppliers, for example, they're they also have to work through this logic, and even customers. So if you look at airlines, they have these frequent flyer miles. So some customers are very loyal to certain airlines. The reason is you fly with one airline all the time, you get all these miles, you get perks, you get benefits because of that loyalty. Well, if the company goes bankrupt and all of these relationships get jumbled up, the whole company gets reorganized or purchased, something like that, what happens to all of those perks, right? How sure are you that you're going to keep them? If you're not sure, then you're not going to be as loyal to the company ex ante, right? You're going to change your behavior, and that's going to be expensive for the company. So, for example, here's a nice little anecdote from US Airways. They went bankrupt in September of 2004, and they sent this letter to all their frequent flyers. They said, I want you to be aware of this important step that the company's taken. We filed to reorganize under Chapter 11. You should understand that US Airways is not going out of business, right? We're going to continue to operate. And further, I want you to know that this announcement has no impact on your dividend miles account and the many benefits you receive as a member. Right? The airline company is trying to reassure their customers to keep the faith, right? Keep the faith in the company, stay loyal, keep flying with US Airways, because that's how they create value. If that loyalty gets disrupted through the bankruptcy process, then that's going to cost the company a lot. It's not a direct cost. It's not you're not paying a lawyer that, but this is an economic cost, right? What's the opportunity cost of getting all of those tax shields? Well, the opportunity cost is you're going to lose some loyalty when you get near bankruptcy. So companies do a lot to try to reassure all of these stakeholders that they will be taken care of, but it's not entirely credible, right? If you were a frequent flyer for US Airways, I'm not sure exactly how much faith you would put in this statement. So that takes us back to Modigliani-Miller Proposition 1 here. We're weighing off these tax shields We're weighing those tax shields off against costs of bankruptcy, in particular, the indirect costs. So now we're not in a world where you want to get 100% debt, because if you do that, you're going to be destroying NPV through these indirect costs. Okay. And this makes sense, right? We all have this sense that bankruptcy is expensive. We know empirically that companies don't use 100% debt, right? In the real world, no one has 100% debt or even close to 100% debt because bankruptcy is costly. So we've started to get at this issue now. We kind of understand why our simple setting from before, where we just violated the tax assumption and you should take on as much debt as possible, we've seen now why that's not going to work in the real world. We've seen some examples. There's direct costs, legal fees, but there's also relationships with all of the stakeholders that can get severed, and that's expensive. Now, the downside here is it's hard to measure these costs of bankruptcy. We know how to measure the value of tax shields. That's relatively straightforward. Tax shields just look like any other cash flow. So you know exactly how much the tax shields are when you take debt, when you pay interest expenses. You can measure that and value that. Doing it here is much more difficult. What's the counterfactual? How much business could US Airways do? How much extra loyalty would they get if they didn't take on debt? Like that's a much harder thing to answer than what is the value of a tax shield. So it's very difficult to quantify these costs, but we have an idea that they are important. Next, I want to talk about how bankruptcy interacts with information and incentive problems. So again, pulling up Modigliani-Miller, one type of bankruptcy cost is conflicts of interest between equity holders and debt holders. Right? They both have claims on the business. We saw that if you're reorganizing the company, They have incentives to kind of fight each other to get a bigger share of the pie in reorganization. But that problem is true even before bankruptcy. Okay, so even before the company goes through a reorganization, there's still going to be conflicts of interest between the banks and the equity holders. And those conflicts of interest are going to destroy value. Okay, that's what we're going to talk about next. The main issue here is that shareholders usually make the decisions, right? Who appoints the CEO? It's going to be the board of directors. Who votes on the board of directors? It's usually the shareholders. So the shareholders have control over the operations of the company. That can create conflicts of interest between shareholders and debt holders. The shareholders may choose to pursue self-interest rather than maximize the value of the company. So in fact, the shareholders may be happy to destroy firm value because by destroying firm value, they're actually increasing the value of equity. Right? You can think of situations, we'll go through some examples like this, where the total company of the total value of the company falls, but the value of equity rises due to these conflicts. The conflict is best seen in a picture. So here we have the value of the company plotted against the value of each claimant's claim. On the x-axis, this is the total value of the company, right? So this is assets. This is equal to debt plus equity. On the y-axis, we have the value of a given claim. I made a mark on the x-axis here for the debt obligation. This is how much the company owes the bank. They owe their debtors some amount, that's this. Equity holders can't get paid until the debt holders are paid. Right? You have to meet this obligation in order for equity to be worth anything. So what do the payoffs look like for debt and equity? Well, if the company is worth close to zero, then the debt holders are going to get everything. Right? So there's this 45-degree line here, where as the value of the company goes up, the value of the debt goes up, because if the company is bankrupt and they can't meet their debt obligation, you're below this line, this little mark here. If you're below this tick, then everything goes to the debt holders. So as the value of the company grows, you move along the x-axis, the value of the debt goes up 1 for 1. Okay, so the green line here is the value of the debt. Once you pay off the debt, you meet this debt obligation, you go up on this tick to the green line, and then the value of the debt is flat. Right? The debt holders don't get any more when the value of the company goes up. You pay the debt holders the obligation, you pay them what you owe them, but you don't pay them any extra. You don't pay them a bonus or anything special. You just pay them what's in the contract, and that's all that they're going to get. So the value of the debt flatlines once you meet the debt obligation. What does that mean for equity then? Well, the value of equity is worth nothing until you pay off the debt. Okay, so the value of equity is 0, 0, 0, 0, 0 until you meet this debt obligation. And then once you meet the debt obligation, debt holders don't get any more money. Everything else goes to the equity holders. So now we have a 45-degree line for equity. Equity is getting 100% of everything past the debt obligation. Anytime you see a weird kink like this in a figure, you're going to be worried about incentives. For the equity holders, their downside is limited, right? If the equity holders are around zero, say the company is around bankruptcy, okay, so let's just pick a point here. The value of the company is worth a little bit more than what you owe the bank, but not much. From the equity perspective, the downside is quite limited, right? The value of the equity is already pretty low. If you make a really bad investment, then the value of equity goes to 0, but it's already pretty close to 0, so that's not a big deal. On the other hand, if you take a gamble and things work out, the equity holders get all of the upside. Okay, so this is the asymmetry that's going to create conflicts. Equity holders get upside, and the downside isn't that big for them, right? It's limited to 0. So especially if you're around 0 already, suppose you're already kind of bankrupt, the value of the equity is at 0, equity holders have nothing to lose. So the downside, they don't even care about it anymore. All they care about is the upside. This creates bad incentives. Equity holders may be willing to actually destroy the value of the company if it gives them more upside. That's the only thing that they're going to care about. The debt holders then are going to get expropriated a bit because they're not making the decisions. Equity holders are the ones who generally are in control of the most important operating decisions for the firm. If the equity holders don't care about the downside, well, that means that the debt holders are going to pay those costs. That's a cost of distress for them. Okay, so let's see an example. We'll work out some numbers and make it more concrete. Here's a balance sheet for a company that's pretty much bankrupt. We've got two assets. They've got cash and some fixed asset, some operating asset. The book value of the cash is 200. The book value of the fixed asset is 400. So the total value of the company is 600 on the books. But that's not what it's actually worth. In this example, the asset's worth nothing. Suppose it's some company where it just became outdated and no one uses it anymore. Just overnight, everyone switched to some competitor, say. So this asset is worth 0. They still have the cash. And so, like we said, the accountants are good at valuing cash. The book value is 200. The market value is also 200. The total market value, therefore, is 200. Okay, it's all in the cash. The operations are worthless. Let's turn to the other side of the balance sheet, debt plus equity. We can look at the book value. We owe the bondholders $300. That's what's on our books. And the equity is worth 300 on our books. So, okay, we get that same 600. But as we saw, the total value of the company isn't actually 600, it's only 200. So who's going to get that $200 in cash? Well, the equity holders get paid last, so they're not going to get that cash. Rather, the 200 is going to go to the bondholders. They have priority. We owe the bondholders 300. That's what we owe them on the books. We only have 200, so we're just going to have to give the entire 200 to the bondholders. So if you liquidate the company, the bondholders get the full $200. The shareholders are left with nothing. That's the setup here. Now, let me write that on the whiteboard. Just copy this so we have it. Suppose, however, that the equity holders are given the following investment. It's a gamble, right? So if they win, this only happens with probability 10%, they get a big payoff of $1,000. If they lose, they get nothing. That happens 90% of the time, right? So it's kind of like a lottery ticket. You win or you lose. Most of the time you're going to lose and get no money, but sometimes you make it big. Suppose that this risky investment costs $200. Okay, so this was pretty convenient. This was just how much cash does a company have. Cash is worth 200, so you have to put all of that cash into this investment. The required return is 50%, and say the payoff occurs at time 1. With a discount rate of 50%. Well, what's the NPV for this investment? We go back to very early on in the semester. What is the expected cash flow? Well, 10% of the time you get 1,000, and then 90% of the time you get 0. Okay, so the expected cash flow is just 100. That occurs at time 1. And the cash flow today at time 0 is the minus 200. You have to pay $200 to buy this lottery ticket, and you get an expectation of $100. So obviously the NPV is going to be terrible here. It's minus 200 plus 100 divided by 1 plus 5. Okay, so we get just a horrible NPV. Okay, minus $133. So do not take this. Obvious upon inspection. What's the problem though? Are the equity holders going to be satisfied with this analysis, right? The equity holders are making the decision. Are they going to want to invest? If they don't invest, how much money are they going to get? They're going to get zero, right? The company's only worth $200 and you owe the bank $300, so the equity is going to be wiped out. Suppose you do take the gamble. What's the payoff going to look like for equity? Well, 90% of the time, the equity is still going to get zero. Okay? If you don't take the gamble, equity gets zero. If you do take the gamble and 90% of the time it doesn't work out, equity holders left with zero. So, who cares, right? From the equity's perspective, they're still getting zero. 10% of the time, however, this gamble is going to work. The gamble is going to pay off 1,000. That's going to be more than enough to pay off the bank at time one, or today, right? We owe the bank $300. So if things work, what's going to be the kind of the equity payout? Well, 90% of the time you get nothing, but 10% of the time the gamble works and you get $1,000, and then you have to pay the bank the $300 that you owe them. Equity is still going to be worth $700 in that case. So the equity is going to be worth $70. That's going to be the payout to the equity holders if you take the gamble. So they're going to want to do this. That's the punchline. From the equity holders' perspective, this is going to look very good for them. It's still risky. So this $70 occurs in a year, and there's a 50% hurdle rate. So you can calculate that the present value of the stock is 47, but that's still better than zero. Who's going to lose value? Well, we saw that this investment destroys $133 in value. The bonds should be worth $200, right? The value of the bond should be $200 if you just give the bonds the cash. It should be worth $200. But we see that we've destroyed 133. So now at most the bonds are going to get 200, minus 133. But in fact, they're going to get a little bit less because now the equity holders are going to get some cash. So if you take the investment, the bonds are only going to be worth 20. They only get that $300 10% of the time. So in expectation, they're only going to get $30 instead of the full $200. And of course, that $30 is risky. You have a hurdle rate of 50%. So the bondholders are going to be losing a lot. They're going to go from 200 down to 20. You see that what's the total value of the company? Well, it was 200, but then we've lost $133. Right? That if you take the gamble, you destroyed $133. So the total value of the company is only the $67. This gets split between debt and equity. So if the equity holders are getting $47, then that means the debt is only worth 20. So the value of the equity actually went up from 0 to 47. The value of the debt went down from 200 to 20. They bore that entire cost. This is called risk shifting. And we can look at this picture. We can revisit this picture to see what was happening. We owed the bank $300, but we only had $200 in cash. Okay, so we were here. The equity holders have some gamble now. They know that most of the time they're going to lose the gamble, but from their perspective, they're not going to get any money already. They're already getting paid zero. So if they just tank the value of the company, they're still going to get zero, no problem. But there's some chance that things work out well, and that $200 in firm value jumps up to $1,000, so way up here, and the equity holders capture that upside. They don't have any downside, they capture the entire upside. We call that risk shifting. Okay. So yeah, it's all about that asymmetric payoff. Sometimes this is called gambling for resurrection. Sometimes you'll see that with banks in particular. If banks are kind of close to failing, they'll take risky bets because they don't bear the losses. Bondholders obviously aren't going to like this. We saw that they lost $180 in value. That was entirely concentrated with them. Okay. What's another selfish strategy that equity holders can take? This is called debt overhang. In some sense, it's the opposite of risk shifting. With risk shifting, you're going to take a bad bet because your payoff is asymmetric. With debt overhang, you're not going to take a good investment. There's going to be a good investment that comes your way. But the problem is, if you take this good investment, you know that the debt holders are going to benefit. Okay, so the equity holders don't want to spend any time or effort or cost for good projects if the beneficiary is going to be the debt holders. Okay, that's what we mean by debt overhang. So think about the same company, same balance sheet here. There's a project that costs $300. And if you take the $300, you get a guaranteed payoff of $350 in a year. And it's government sponsored, so it's a perfect investment. We have a required return of 10%. We can walk through the NPV and see that it's going to be a good deal. So you have to pay the initial investment of I, and then you get some cash flow in a year. So you have to put in the $300 today, and then you get $350 back in a year with a required return of 10%. You'll see that our day one NPV calculation is going to show that this is a good deal. We're going to have an NPV of $18. We should take it. What's the problem? The investment costs $300. The company only has $200 in cash. Okay, recall the balance sheet here. We only have $200 in cash. You need $300 in order to take this good deal. So who's going to have to finance this? Well, the equity holders would have to chip in an extra $100. Are they going to want to do that? So what's the intuition here? We go back up to our picture. The company's only worth $200. You have a good project, so you're going to increase the value of the company. But when you increase the value of the company from 200 to 218, right? You're increasing it by 18. That's the NPV. Who's benefiting? It's going to the debt holders. Like the debt holders benefit. So if the equity holders have to put in $100, all they're going to be doing is transferring money to the debt holders. So they're not going to want to do this. And so we can work through the payoffs for the equity holders here. Equity, if they don't take the investment, the equity is worth $0. That's the same as before. If equity does take the project, well, they have to put in $100 today. They have to chip in that extra $100 to finance the project. And what do they get out of it? Well, they'll get the company will get $350 in a year. How much do the equity holders get to keep? They only get to keep 50. You owe the lenders $300. That was the book value of their debt. Right? You owe the bondholders $300. This project's going to pay back $350. So that means there's only going to be $50 left for equity holders. So this is going to look really bad for equity holders. The NPV for equity is going to be minus 54. So even though the project has a positive NPV, it's not positive NPV from the equity holder's perspective. The difference here, this 54 and 18, the difference is of about 70. That's an increase in NPV going to the debt holders. So the debt holders were only going to get 200 before, but now they're going to get the 272. Roughly 272 there, because the equity holders are essentially financing the project. They're financing the positive NPV that the debt holders get to collect. So they're not going to want to do that. These two problems, risk shifting and debt overhang, are very tricky because the one, risk shifting, the equity holders are taking bad investments. They're taking too many risky investments. On the other hand, with debt overhang, equity holders aren't investing enough, right? There's good investments that they should take and they're not going to take them. So from the debt holders' perspective, it's very hard to disentangle these things. Do you want the equity holders to invest or not? Well, you want them to invest in good projects, but not bad projects. But if the debt holders aren't running the company, it's not going to be easy for them to see which ones are good and which ones are bad. They're not going to be able to differentiate between risk shifting and debt overhang investment decisions. So if shareholders have to finance this by putting money into the project, bondholders are going to benefit when things go well, and shareholders are not going to get their money back. This means that companies aren't going to want to kind of raise equity when they're close to bankruptcy, because obviously the payoffs, the upside is limited for them, and if they have to put in the entire amount, they're not going to get the upside. A third selfish strategy is very simple. It's just called milking. The idea here is the equity holders are going to want to try to cash out as much as they can. If they know the company is close to bankruptcy, and if you think about this balance sheet here, what would be the simplest thing the equity holders could try? Well, you see you have $200 in cash. Maybe you just try to write a check to the equity holders, pay a special dividend to the equity holders so they get the 200. That's the basic idea, that you want to try to do this. It's not easy legally to do this, but that's kind of the intuition. They want to do something like that. So how can these costs be reduced? Well, the bank's going to write certain things in the contract, but I mean, the big picture is it's hard, right? We said that from the lender's perspective, it's very hard to differentiate risk shifting from debt overhang, for example. So it's very hard to reduce these costs. The equity holders have discretion, and they're the ones making the decisions. So that's very hard for the debt holders to constrain. Bondholders can write covenants. The idea here is that if the company is in trouble, then they won't be allowed to make dividend payments, for example. So that would be a very simple thing to do. If the earnings of the company go below a certain level, then the bond will say legally the company cannot pay any more dividends. That would be one way to prevent like a liquidating dividend, for example. This milking strategy can be avoided if the bondholders can kind of get in there soon enough, and they write it in the contract so that the equity holders can't do this. But generally speaking, it's going to be very difficult to reduce these problems. One way, another possibility, is if bondholders can try to influence CEO compensation. Remember, the CEO is making the decisions, and so you want to try to align the CEO's incentives with the total value of the company rather than the value of the equity holders. We go back up to this picture again. I think this is the cleanest way to see it. We said the entire problem stems from this kink. Right? Equity doesn't bear any downsides around bankruptcy. They get all of the upside. So what you want the CEO's contract should look linear. Right? The CEO's contract should go up 1-for-1 with the value of the company. So, for example, let's copy paste this picture here. No, that's not going to work. The CEO's payoff could look something like this. Let me just put it on the slides. That would be the ideal. You want to eliminate the kink for the decision maker. Okay, so let's put that in red here. How could you do that? Well, one way is to give the CEO debt. Instead of paying the CEO entirely with equity, maybe you give the CEO some debt. So if the company has bonds, you pay the CEO with bonds and equity so that the CEO's compensation goes up when the value of the company goes up, not necessarily when just the value of the equity goes up. Okay, that's one idea. It's a little bit hard to implement this. For CEOs, instead of getting bonds, one way they'll do this is with very generous pension contracts. Why is that? Well, if you go into bankruptcy, the CEO would lose their pension, or they could potentially lose their pension before some of the creditors. And so if we go all the way back up here, the employees, they have these benefits here. They get paid after the secured creditors. They're getting paid around the time of the unsecured creditors. So if you can put the CEO in this bucket and make sure that the CEO has a lot of money on the line here, a lot of benefits that have accrued in the form of a pension, then the compensation starts to look a little bit more like the debt holders. And therefore, the CEO's compensation, the CEO's incentives may look more like the debt holders and not just like the equity holders. So that's kind of one proposition that folks have talked about. Yeah, in practice, I don't know how powerful that is. That brings us to the trade-off theory. As I alluded to at the very beginning, we're just trading off the interest tax yields against all of these different costs of debt. So let me lay out the cost of debt one more time. There's direct costs. All these fees and lawyers that come in when you go into bankruptcy. And then there's some indirect costs. So one example here would be the stakeholder relationships get frayed. You're not going to have loyal customers if the customers know that you're just going to kind of go back on your word in bankruptcy, right? In bankruptcy, all things get reshuffled, and so any promises that the company made before bankruptcy, they kind of go out the window. And then another indirect cost are these incentive problems. We saw that the equity holders are going to want to destroy value because it's better for them. It's going to be worse for the debt holders. It's going to be worse for the company. So it's a cost for the entire company when you have these conflicts. The trade-off theory is going to say we're going to weigh these costs of debt, all of them here. We're going to try to value them and put them against the tax shields. You take enough debt so that you get the tax shields, but not too much that these costs start to offset the value of the tax shields. Okay. So if you want to think about this in an equation, we have the total value of the company. It's going to be the value of the company if it had no debt, right? It's the all equity firm, the unlevered company. But then you add the tax shields and subtract all of these bankruptcy costs or costs of distress. That means there's going to be a trade-off between the tax shields and these costs of distress. We're not going to be able to put a number on it because as we talked about, especially these indirect costs are going to be very, very difficult to measure. We're dealing in terms of counterfactuals. What would the stakeholder relationships look like with debt versus without debt? That's a very hard thing to put a number on. Likewise, these conflicts of interest. If you think about these, right, the debt holders don't know enough to deal with these conflicts. So how are we going to try to measure these costs, right? If the debt holders who are invested in the company, if they don't know why if they can't tell when the equity holders are destroying value, how are we as kind of observers going to be able to tell that and put a number on it, right? We just can't do it. But we can think through it at least, kind of graphically get the intuition down. The idea here is that as you take on more debt, we have debt on the x-axis and we have the value of the company on the y-axis. VU, that's the value of the unlevered company. Right, so let's just draw a horizontal line there to get our benchmark. V is going to be the actual value of the company. As you take on more debt, you get tax shields. Okay. So if that's the only thing that we're dealing with, then we saw that the line just goes out straight. The value of the company goes up and up and up with those tax shields. And that's this top line here. The value of the levered company is the value of the unlevered company plus the tax shields. We saw this very simple example with Modigliani and Miller. Once we incorporate bankruptcy costs, however, then the value of the company starts to actually drop. The actual value of the firm drops if you start to take on too much debt. The bankruptcy costs start to outweigh the tax shields, and so the total value actually goes down when you take on more debt. The trade-off theory says that what you want to do is you want to find this maximum point. You want to maximize the value of the firm, that's the y-axis. You do that by taking on enough debt so that if you take on just a little bit more debt, then the value of those extra tax shields are equal to the value of the extra cost of distress. Okay, so you hit that flat point in the line where the costs and the benefits of taking more debt completely offset each other. And if you start to take on more debt beyond that, the cost of debt outweigh the benefits. So that's what this inverted U shape is signifying. With just a little bit of debt, you're okay. You want to keep taking a little bit more debt, because you get those tax shields. But then once the debt starts to accumulate, then the costs also start to accumulate, and they outweigh the tax shields. We can view this in terms of the Modigliani and Miller pie story before. Now we're just cutting the pie into an extra couple of different costs. So if we have debt and equity, if you have more debt, what's going on is the government is getting less of a share, but now the cost of bankruptcy goes up. Okay, so if you think of L being payments to the lawyers, as you take on more debt, the slice of G gets smaller, but the slice of L goes up because of the cost of bankruptcy. And then so you're trying to take on just enough debts to maximize the value of D plus E. But once you start taking too much, then the lawyers are going to get the value from that. Empirically, we can look at different industries and see how much debt they have. So we've got different industries in the first column, and then we have leverage in the second column. Leverage being the fraction of the company owned by debt holders. So debt divided by debt plus equity. And what we see is that industries where there's a lot of kind of tangible assets, buildings, airplanes, factories, and supplies, they generally have a lot of leverage. Companies where the assets are mostly intangible, there are ideas, there's drugs and chemicals, electronics, computers, management, those have very little leverage. And so you see here that these information problems become important because these companies have collateral, right? Just like if I get a car loan, if I don't pay on the loan, the bank takes my car. Well, the bank's going to be doing something very similar for these companies. If the hotel and lodging company doesn't pay the bank, then the company can go in and seize the property. The bank can seize the real estate that the company owns. With these companies up here, with the top companies, the idea companies, the intangible companies, what's the bank going to do? If the company doesn't pay them, the bank can't take the ideas, take the code. It would be very hard for the bank to do something with that stuff. And so this kind of information problem and an agency problem becomes very stark, and hence they just don't have any leverage to begin with. That wraps up our discussion of bankruptcy. Next, I'm going to talk more about asymmetric information by itself. So we saw how asymmetric information interacts with bankruptcy, right? The equity holders know more about the value of the company than the debt holders. But that's true even without debt. Management's going to know a lot more about the company than everyone else, and that has implications for capital structure as well. To give away the punchline right away, with this type of information, with this type of information problem in the pecking order theory, the company's going to be pushed to take more debt. When we talked about bankruptcy, we saw that there's information problems there. If the equity holders are running the company, they know more than the debt holders. That's a cost of bankruptcy, so that pushes the company away from debt. We'll study a different type of information problem here, which is going to push the company toward debt. That's the pecking order theory is going to give us that result. So with asymmetric information, we're thinking of things from the company's perspective now. If the company has to make a decision between debt versus equity, how does asymmetric information affect that problem? How does the fact that managers know more about the company than investors, how does that affect the decision to raise money? So let's think about two companies. There's a little thought experiment here. O and U. To investors, they look the same. Okay, investors can't tell O from U. Here's where information asymmetry comes in. The management knows more than the investors about the company. In particular, O's managers know that O's stock is overvalued. Okay, O for overvalued. They know that the traders are kind of pushing the price up too much. It's not worth that much. On the other hand, U's managers know that the stock is undervalued. The stock market is penalizing them too much. The intrinsic value of the company is more than what it's trading for in the stock market. But to investors, it looks the same. It's just management knows more than investors. Now, both of these companies have an investment project. They need to raise money. Who's going to use debt and who's going to use equity? Well, let's think through the thought process. I'm sure you can kind of put yourself in their position and go through that exercise. If you're a manager of O, you know that the stock is overvalued. So that's a pretty good time to issue equity. Investors are willing to pay kind of too much for the equity, and so you should sell more of it, right? The investors are going to give you free money, basically. They're going to pay more than the company's worth, so you should issue equity. The managers of U are thinking the exact opposite. They're saying our stock is undervalued. If we issue more stock, if we sell more stock, investors aren't going to pay as much. They aren't going to pay much for it. They're not going to pay what it's worth. So if we issue stock, it's like giving a gift to these new investors, right? They're buying in at too low of a price. We don't want to do that. So instead, you is thinking, instead of selling stock to raise money, we're just going to issue some debt. We're going to take a loan instead of using equity. Whereas O is thinking the opposite. O says, well, we're going to issue equity instead of a loan. The issue is investors are not dumb. Investors, maybe they don't see everything, so that they can't tell O from U at the beginning, but they're going to learn from the decision. They're going to learn from the decision about how to raise money, and that's going to inform investors. They're going to be able to back this out. So in particular, if they see a company's issuing stock, they're going to be undoing this process. If they issue stock, they're going to say, oh, this must be what managers of O are thinking. They must be thinking that the stock is overvalued, and that's why they're going to issue stock. Conversely, if they see a company use debt, they're going to see that as a relative sign of undervaluation. If they're not going to issue equity, it must be that the equity is undervalued somewhat. Okay. Once investors back this out, we'll see that O's stock price should drop when it announces a stock issue, eliminating this overvaluation. And that's in fact what happens empirically. So in this figure, this was a paper written 20 years ago, but I'm sure the result still holds. It's a very robust finding. On the x-axis, we have days since the announcement of an equity issue. So these are companies that are already public. They're already trading on either the New York Stock Exchange or Amex for this line, or over the counter for the top line. At day 0, that's when they announce they're going to sell more equity to raise money. We have day minus 500, that's 500 days before the announcement, up to day 100, 100 days after the announcement. And then on the y-axis, we have the cumulative abnormal return. So they start at 0, hit minus 500, and then as time goes by, the stock is going up, up, up. So these are stocks that are doing abnormally well. They're doing better than the stock market, better than the overall market, until they make this announcement. Okay, so going up, 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 up. The NYSE stocks go up 40%, and then they make this announcement, we're going to sell more stock. And what happens? Investors realize that this company must be overvalued. That's why they're selling stock. And so the stock price drops at the announcement date, and then it flatlines going forward. So that's the pecking order theory. You've revealed information now. As soon as you say you're going to issue equity, you're telling the world your information. You're saying that the company's overvalued. And so that gets factored into the prices. That gives us what's called a pecking order. A pecking order just means you prefer to raise money In some ways rather than others. There's an ordering. Equity is at the bottom, right? You don't want to raise equity unless you have to, because as soon as you raise equity, this is what's going to happen, right? Everyone's going to think, oh, okay, this company must be overvalued, so stock price is going to take a hit. So equity is the last thing you want to do. It's the bottom of the pecking order. You would prefer to issue debt because debt sends a signal of relative undervaluation. And in fact, you would want internal finance even more. Internal finance means you're financing with the cash you have on your balance sheet. You're not raising any more money at all. You're using the cash that the company already has and using that to finance projects. That sends no signal, right? It doesn't say anything about, it doesn't indicate that the debt is overvalued or that the equity is overvalued, right? If anything, it's signaling everything is undervalued, and that's why you're using your cash rather than raising more money. So that's the pecking order. Internal finance is best. It's preferred to debt. It sends less of a signal than debt issues, and debt issues obviously send less of a signal than equity. So equity is at the bottom of the ordering. So to conclude for today, we've talked a lot about Modigliani-Miller. We've walked through these assumptions some more. We started off today in corporate finance just dealing with taxes, and we said that because of taxes, debt is preferred. You get these tax shields with debt, and so you should take on as much debt as possible. We studied the cost of bankruptcy and discovered that there's a trade-off here. If bankruptcy is expensive, you have to weigh those costs against the tax shields and try to get some optimum point. There's information problems and incentive problems there, and so debt is used mostly by companies that have a lot of collateral, right? Again, if you buy a home or you buy a car, the bank doesn't know that much about you, but they know that if you don't pay off the loan, they can take your car, they can take the house. So that's one way to solve the information problem. That's where we saw industries with a lot of debt were companies that had a lot of collateral, because otherwise the bank doesn't really have any way to make sure that they can get paid. If the only collateral you have is like an idea in your head, the bank can't get a claim on that. So there's a trade-off. We also saw that there were more subtle costs of bankruptcy from the conflicts of interest. We saw that there's risk shifting and debt overhang. So now equity holders are destroying the value of the company because in doing so, they're actually raising the value of equity due to these weird conflicts of interest between debt and equity holders. So those things push us against taking debt. But then we ended with another story where we just relaxed the information asymmetry. We kept everything else the same. And the only friction we added were these information asymmetries between the management and all the rest of the investors. We saw that if you do that, you actually are pushed toward debt again. You're pushed away from equity and toward debt because that sends less of a signal of overvaluation to the market.